In this video, we cover recession odds, some subtle but important changes to the current trading range in stocks, the month-end status of numerous long-term bearish signals, and the current risk-reward profile of the stock market and risk assets in general. The stock market tends to lead the economy rather than the other way around. So the stock market, commodity markets, and the bond market have been telling us for some time that the odds of a recession have increased dramatically. This week, the Economic Cycle Research Institute came out and basically said that their most reliable forward-looking indicators are now forecasting a recession, and they're saying that it's a foregone conclusion. So their analysis with economic indicators aligns well with our analysis. The point for us as investors is stocks are not a good place to be on the front end of a new recession. This is a daily chart of the S&P 500 index as of the close on Friday, September 30th. Here's the plunge early in August, and here's the trading range that we've been in. What we don't want to do is get lulled into we're in a trading range mentality and not focus on some potential changes within the range. These are trend lines, so you can see when we bottomed on August 8th that if you connect these 2 points, this is a higher high that's bullish, and draw a parallel trend line, you can see that this trend channel bounded by the parallel green lines is bullish. It's sloping upward. The next slide will tell you how we drew all these trend lines if you want to pause it and see how that was done. The point is, here we made a lower high, so this trend channel now is starting to slope downward. And then here we made a lower low relative to this low. So if you draw a line connecting this low and then put the parallel line up here, you can see that the uptrend appears to be shifting to a downtrend. Again, if you take this high and this high, draw a parallel line, a trend line, and then a parallel trend line here, it's possible that we could move down to either this red line next or this blue line. Now, what's also possible is that we bounce back up towards the upper end of this range. If we go and close above 1180, or we close above 1210-ish, 1215-ish, that's a short-term win for the bulls and may increase the odds that we break out of this trading range to the upside. Presently, as of the close on Friday, you can see here that the odds now are pointing towards us breaking out of this range in a bearish manner. We're not going to spend a lot of time on this slide. If you want to learn a little bit more about how these trend lines were drawn, simply click on pause, and then you can read some of this, and then click on play to resume. If you've seen some of our videos before, you know we've been showing a monthly chart of the S&P 500. We're going to update it here and go over the basic concept one more time in case you're a first-time viewer. The important thing to us today is this is a bearish signal, this crossover here, and we'll explain why momentarily. But the important thing is that this signal here, this bearish signal, has now carried into month end for the first time, which we'll note as we update other bearish signals on the next slide. We'll note why that's important. If you haven't seen this before, the black line is price. These are Bollinger Bands. As we've mentioned before, you don't need to know anything about Bollinger Bands or what they are or how they work. You just need to know this. When price on the monthly chart, the black line, is above the center line on the Bollinger Band, the odds favor higher highs in stock prices. You can see here we held at the center line and quickly moved up to the top blue line of the Bollinger Band. You can see here we did not hold the center line, and we relatively quickly moved down to the lower band. And once you're below this center line, the odds favor lower lows. This is what a bear market looks like. This is a bullish crossover. This is what a bull market looks like. bearish signal, bear market. The point now is we've gotten the first bearish signal, again, that's carried into month end, which makes it more meaningful and more important. Typically, when you get the bearish signal, eventually you move down to the lower Bollinger Band. Bearish signal, move to the lower Bollinger Band. If we were to move to the lower band now, that level is roughly 1,000 on the S&P 500. Now, it should be noted that here we got a significant counter trend rally and a bounce, and we got a significant counter trend rally here, and both of those occurred before we made it to the lower Bollinger Band. So if we break out of the current trading range on the S&P 500, it would not be surprising to see somewhat of a whipsaw action that takes us up back toward the lower end of that trading range before we come down and make lower lows. All of these sell signals, and you have to put those in quotes, are probabilistic in nature, and they speak to probabilities. The odds are that we're going to go lower now that this signal is in place. That doesn't mean that's what's going to happen. It just tells us that the odds favor lower lows. These are other long-term sell signals that we've shown in past videos. We won't bore you by going through them all again. If you want to get a visual on what these sell signals look like, you can Google this here and you can find the older videos and watch them. The point of the update here is we mentioned in the past that these monthly bearish signals would become more meaningful if they held into month end. Well, every long-term bearish signal that we've shown in recent videos, every single one of them is still on a bearish signal, and they did hold into month end. So we're not the only ones looking at these types of signals. Any hedge fund or institution that has a technical analyst on their staff will be aware of the fact that they are now enforce these longer-term sell signals on a wide variety of markets. And we've got sell signals on more markets than this. This just gives you a broad brushstroke. Again, these are probabilistic in nature, and what it tells you is hedge funds and institutions will probably be a little bit more willing to sell stocks and or go on the short side of the market beginning in the first week of October. We're not going to cover too much on this flow chart. We just wanted to show some readings, current readings on one of our proprietary models, the Shavako Capital Management Bull Market Sustainability Index. The point of showing this is you'll read analysis and opinions of people saying that the market's oversold on one particular parameter and thus is due to rally. This proprietary model that we have uses all of these indicators on daily, weekly, and monthly charts and combines them and looks at historical profiles of markets and then calculates risk-reward ratios, which is what we care about. So let's just show you one example of how it works. The relative strength index, let's say we looked at the current chart of it and the value was 15. You come up here, does a 15 on an RSI look more like a bull market or a bear market? Well, if you know anything about RSI, an RSI reading of 15 looks more like a bear market. So you would subtract points from the model based upon some weighted composites and probabilities. If that figure on RSI doesn't look like a bull or a bear market, you don't add or subtract points. If the figure that you have in the current market is unique to bull markets, then you add some points. So ultimately what it enables you to do is get a single score for the present day market based upon all these parameters, and then you can look at historical scores and say, does the present market look like a bull market or does it look like a bear market? And we'll answer that on the next slide. This table shows us the current risk-reward profile of the S&P 500. If you want to learn more about the Bull Market Sustainability Index, you can go to our website and in the left-hand margin click on this link. Right? What does this tell us? It tells us that the score, based upon the flow chart and the model that we just looked at, for the present market falls into this range. What these tell you, these are risk-reward ratios historically. So historically, when a score falls into this range, looking out 1 month on the S&P 500, your risk-reward ratio is 0.3. That's not a favorable ratio, hence why it's in red. The takeaway for us now is these historical risk-reward ratios that match up with the current market are some of the worst that you'll find looking out 1, 2, and 3 months. So what does that mean to us today? It just tells us that the odds are not in our favor currently as investors. And these red boxes, really anything under 3 is not all that favorable. So we're in a range right now that's not that favorable. And it just tells you that when you put capital at risk, that the odds are not in your favor. And actually, when this ratio is below 1, it tells you that the odds favor lower lows and that inverse positions or shorting actually has a better chance of being successful than owning stocks or going long. The last thing that we'll mention is you'll notice here the odds begin to improve a little bit, and it's possible this is the area that you get into somewhat of an oversold condition where the market comes down and bounces, where we showed you that on the Bollinger Band slide. So right now, risk-reward ratios are not favorable. Does that mean that the stock market cannot go up? Absolutely, positively, no. It can go up, and that's why we look at risk-reward ratios. Markets can go up in this instance. They have in the past, but on average, they've gone down, and the average loss relative to the average gain has been unfavorable. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.